Question 8. How concentrated are the holdings of the EWU ETF? The EWU ETF, iShares MSCI United Kingdom ETF, exhibits a degree of concentration in its holdings, although it offers some diversification benefits. Here's a breakdown of this concept. Concentration versus diversification. Concentration. An ETF is considered concentrated if a relatively small number of holdings represent a significant portion of the overall assets. This means the performance of the ETF is heavily influenced by the performance of those few companies. Diversification. Diversification involves spreading your investment across various assets to mitigate risk. An ETF, with a broader range of holdings from different sectors and company sizes, offers greater diversification. Concentration in EWU. Market cap weighting. EWU most likely tracks a market capitalization weighted index. This means companies with a larger market cap have a greater weighting within the ETF. As a result, the top holdings, large cap companies, will naturally represent a significant portion of the ETF's assets. Impact of concentration. Potential for higher returns. Large cap companies can sometimes outperform the broader market, potentially leading to higher returns for the EWU ETF compared to a more diversified option. Increased volatility. Concentration also exposes the ETF to greater volatility. If a few of the top holdings experience significant price declines, it can have a more substantial impact on the overall performance of the EWU ETF compared to a more diversified holding. Level of concentration in EWU. Number of holdings. While EWU offers exposure to a basket of UK equities, typically around 80 to 90 companies, the top 10 holdings might represent a significant portion of the total assets, often exceeding 20%. This indicates some level of concentration. Sector allocation. The sector allocation of EWU might also be a factor. If the ETF is heavily weighted towards a few specific sectors, its performance becomes more reliant on those sectors' performance compared to a more balanced sector allocation. Alternatives for diversification. Broader UK market ETFs. Consider ETFs that track a broader UK market index, potentially including mid-cap and small-cap companies alongside large caps. This can offer greater diversification and potentially lower volatility. Global ETFs. Explore ETFs that provide exposure to a basket of stocks across developed or emerging markets. This can further diversify your portfolio and reduce reliance on the performance of the UK market alone. Question 9. Could there be situations where it's difficult to buy or sell shares of the EWU ETF due to low trading volume? While the EWU ETF, iShares MSCI United Kingdom ETF, is considered highly liquid, there are some rare situations where buying or selling shares could be difficult due to low trading volume. Here's a breakdown of the factors at play. EWU's typical liquidity. High trading volume. EWU typically experiences high daily trading volumes, meaning a large number of shares are bought and sold each day. This ensures a readily available market for investors to enter and exit positions. Market makers. The significant asset base of EWU attracts market makers who provide bid-ask quotes, facilitating smoother trading throughout the trading day. Scenarios for lower liquidity. Market closures. On weekends and holidays when the NYSE Arca, where EWU likely trades, is closed, buying and selling activity is naturally halted. However, you can place limit orders in advance that might be executed when the market reopens. After-hours trading. Trading volume typically decreases during pre-market and after-hours trading sessions. While some investors might still be able to buy or sell shares, there might be wider bid-ask spreads, the difference between the buying and selling price, and potentially less certainty about getting the desired price. Black swan events, unforeseen and catastrophic global events, like major wars or financial crises, can cause significant market disruptions and potentially lead to lower trading volume across all assets, including EWU. In such scenarios, executing trades at your desired price might become more challenging. Likelihood and impact. The above situations are uncommon for EWU due to its high average daily trading volume. Even in scenarios with lower volume, limit orders can help you potentially get your buy or sell order executed at a specific price point, although it might take longer. Wider bid-ask spreads during lower volume periods can increase your transaction costs slightly. Strategies to mitigate low volume risk. Trade during regular market hours. Focus on buying or selling EWU shares during regular trading hours on the NYSE Arca when trading volume is typically highest. Limit orders. Utilize limit orders that specify the price you're willing to pay or accept for the shares. This can help you achieve your desired price target, although execution might take time in lower volume situations. Partial fills. Be prepared for the possibility of your order being partially filled, especially during lower volume periods. You might need to submit multiple orders or adjust the order quantity to fully enter or exit your position. Question 10. What is the sector allocation of the EWU ETF? The EWU ETF, iShares MSCI United Kingdom ETF, invests in a basket of UK equities, and its sector allocation reflects the weightings of those companies within the underlying index it tracks, likely the MSCI United Kingdom Index. Here's a breakdown of how sector allocation works in EWU. Understanding sector allocation. Market capitalization weighting. EWU most likely uses a market capitalization weighted approach. This means companies with a larger market cap, higher stock price or more shares outstanding, have a greater weighting within the index and consequently within the EWU ETF. Sector breakdown. The index categorizes companies into various sectors based on their business activities, e.g., financials, technology, consumer staples. The weighting of each sector within the index reflects the combined market capitalization of the companies belonging to that sector. Example sector allocation in EWU. While the specific allocation can fluctuate over time, here's a possible example of how the EWU ETF might be allocated across different sectors. Percentages are for illustrative purposes only. Financials, 18%. Energy minerals, 14%. Consumer non-durables, 13%. Health technology, 12%. Non-energy minerals, 7%. Commercial services, 6%. Consumer services, 5%. Utilities, 4%. Distribution services, 4%. Other sectors, depending on the specific index holding. Importance of sector allocation. Understanding risk profile. The sector allocation of EWU provides insight into the ETF's risk profile. For instance, a higher weighting towards cyclical sectors like financials or energy can lead to greater potential returns, but also higher volatility compared to a more defensive allocation with emphasis on consumer staples or utilities. Portfolio diversification. Consider how the sector allocation of EWU aligns with your existing portfolio holdings. If your portfolio already has significant exposure to certain sectors, EWU might add further concentration risk. Conversely, it can help diversify your portfolio if it complements your existing holdings. Question 11. Does the EWU ETF focus on large cap, mid cap, or small cap European companies? The EWU ETF, iShares MSCI United Kingdom ETF, primarily focuses on large cap European companies, specifically large cap companies listed on UK stock exchanges. Here's a breakdown of why. Market capitalization weighting, the underlying index that EWU likely tracks, e.g., MSCI United Kingdom Index, uses market capitalization weighting. This means companies with a larger market cap, higher stock price, or more shares outstanding, have a greater weighting within the index. Large cap dominance. In most developed markets, including the UK, large cap companies tend to represent a significant portion of the overall market capitalization. Consequently, they also hold a dominant position within market capitalization weighted indices. Limited exposure to mid and small caps. Minimal weighting. Due to the market cap weighting approach, EWU might have minimal exposure to mid-cap and small-cap companies in the UK market. These companies, despite their potentially higher growth prospects, generally hold a smaller share of the overall market capitalization compared to large caps. Alternative UK equity ETFs. If you're interested in broader UK market exposure, including mid-cap and small-cap companies, you might need to consider alternative ETFs specifically designed to track broader UK market indices. These might be named something like iShares MSCI UK Mid-Cap UCITS ETF or FTSE All-Share UCITS ETF. Impact of large cap focus. Potential for stability. Large cap companies are often established and well-recognized leaders in their industries. This can translate to more stable stock prices and potentially lower volatility compared to mid-cap and small-cap companies. Growth potential. While large caps might offer more stability, their growth potential can be limited compared to smaller, high-growth companies. Question 12. Are there other ETFs that offer broader or more targeted exposure to the European market? Yes, there are several ETFs that offer broader or more targeted exposure to the European market compared to the EWU ETF, iShares MSCI United Kingdom ETF, which primarily focuses on large-cap companies in the UK. Here are some options to consider. Broader European market exposure. Vanguard FTSE Europe UCITS ETF, DG Europe. This ETF tracks the FTSE Developed Europe Index, providing exposure to a large and diversified basket of companies across various European countries, including the UK, France, Germany, Switzerland, and others. iShares Core MSCI Europe UCITS ETF, IEUR. This ETF tracks the MSCI Europe Index, offering similar broad exposure to developed European markets like VG Europe. SPDR MSCI Europe Quality UCITS ETF, QEUR. This ETF tracks an index that applies quality factors like profitability, growth, and leverage to select stocks from the MSCI Europe Index. It offers broad exposure with a focus on financially sound companies. Targeted exposure. iShares MSCI Europe Small Cap UCITS ETF, ISSM. This ETF focuses on small cap companies across developed European markets, providing exposure to a segment with potentially higher growth prospects but also greater risk. Lixor MSCI Emerging Europe UCITS ETF, DRDR. This ETF offers exposure to companies in emerging European markets like Poland, Hungary, and the Czech Republic. These markets can offer higher growth potential, but also come with greater volatility and political risk. Strackers MSCI Europe Value UCITS ETF, XDVE. This ETF tracks an index that selects value stocks from the MSCI Europe Index based on metrics like price to earnings, PE, ratio or price to book, PB, ratio. iShares Euro Stocks Mid-Cap UCITS ETF, DIST. This ETF focuses on mid-cap companies in the Eurozone, offering exposure to a segment that can bridge the gap between large caps and small caps. Question 13. Are there any actively managed mutual funds that invest in European equities and potentially outperform the EWU ETF? Yes, there are actively managed mutual funds that invest in European equities and attempt to outperform the EWU ETF, iShares MSCI United Kingdom ETF. However, it's important to understand the key differences and potential benefits and drawbacks before considering them. Actively managed versus passively managed. EWU ETF. The EWU ETF is passively managed, meaning it tracks a specific index, likely the MSCI United Kingdom index. It holds the same companies as the index in proportion to their market capitalization. Actively managed funds. Actively managed mutual funds have portfolio managers who research and select individual stocks based on their investment philosophy and analysis. They aim to outperform a benchmark index like the one EWU tracks. Potential benefits of actively managed funds. Outperformance. Skilled fund managers might outperform the market by selecting undervalued stocks or capitalizing on market inefficiencies. Flexibility. Active managers can adjust their holdings based on market conditions and their investment outlook. Drawbacks of actively managed funds. Higher fees. Actively managed funds typically charge higher expense ratios compared to passively managed ETFs like EWU. These fees can eat into potential returns. Underperformance. There's no guarantee that actively managed funds will outperform the market. Many underperform their benchmarks after accounting for fees. Manager risk. The performance of an actively managed fund relies heavily on the skills of the portfolio manager. Their decisions can significantly impact the fund's returns. Question 14. Are there other asset classes, such as bonds or commodities, that could provide diversification benefits alongside the EWU ETF? Absolutely, there are several asset classes that can provide diversification benefits alongside the EWU ETF, iShares MSCI United Kingdom ETF, within your portfolio. Here's a breakdown of why diversification is important and how different asset classes can contribute. Importance of diversification. Reduces risk. Diversification helps spread your investment risk across different asset classes. This way, if one asset class experiences a downturn, the losses might be offset by gains in other asset classes, leading to a more stable overall portfolio performance. Complementary performance. Different asset classes tend to have varying relationships with each other. For instance, bonds often perform well when stocks decline, offering a hedge against market downturns. Asset classes for diversification with EWU ETF. Bonds. Investing in a bond fund or individual bonds can provide stability and income to your portfolio. Government bonds, corporate bonds, and high-yield bonds offer varying risk-return profiles. Commodities. Commodities like gold, oil, or agricultural products can add diversification as their prices often have a low correlation with stocks. However, commodities can be volatile and require careful consideration. Real estate investment trusts, REITs. REITs invest in income-producing real estate and can offer diversification and potentially steady dividends. Consider both domestic and international REITs to further diversify. Cash equivalents. A small allocation to cash equivalents like money market funds can provide liquidity and safety within your portfolio. Building a diversified portfolio. Risk tolerance. The ideal asset allocation for you depends on your risk tolerance and investment goals. Aggressive investors might allocate more towards stocks like the EWU ETF, while conservative investors might favor bonds and cash equivalents. Modern portfolio theory. Modern portfolio theory suggests that diversification across asset classes with low correlation can help achieve optimal portfolio returns for a given level of risk. Examples of diversification. 60% EWU ETF, 30% investment-grade bond fund, 10% cash equivalents. This is a moderate allocation with a focus on stocks but some protection from a bond component. 40% EWU ETF, 30% global REIT ETF, 20% high-yield bond fund, 10% cash. This is a more diversified allocation with exposure to various asset classes and potentially higher potential returns, but also increased risk. Question 15. What is the ideal duration to hold the EWU ETF? The ideal duration for holding the EWU ETF, iShares MSCI United Kingdom ETF, depends on your individual investment goals and risk tolerance. There's no one-size-fits-all answer, but here's a breakdown of factors to consider. Investment goals. Short-term goals. If you have a short-term investment horizon, less than 5 years, and need access to your capital soon, the EWU ETF might not be suitable due to potential short-term market fluctuations. Long-term goals. The EWU ETF can be a good option for long-term goals, over 5 years, like retirement savings. Historically, the stock market has trended upwards over the long term, potentially offering capital appreciation for the EWU ETF. Risk tolerance. Aggressive investors with a high tolerance for risk might hold the EWU ETF for a longer duration, aiming to capture potential long-term growth in the UK stock market. Conservative investors with a lower risk tolerance might hold the EWU ETF for a shorter duration as part of a more diversified portfolio, potentially using it for income generation or a moderate growth component. Alternative strategies. Dollar cost averaging, DCA. This involves investing a fixed amount of money into the EWU ETF at regular intervals, e.g., monthly, regardless of the stock price. This can help average out the cost per share over time and potentially reduce the impact of market volatility. Rebalancing. If you hold the EWU ETF alongside other assets, periodically rebalancing your portfolio can ensure your asset allocation stays aligned with your investment goals. This might involve buying or selling the EWU ETF to maintain your desired weightings. Additional considerations. Market conditions. The overall health of the UK stock market and global economic conditions can influence how long you might want to hold the EWU ETF. Significant downturns might warrant a temporary shift in strategy. Investment strategy. Are you aiming for capital appreciation, income generation, or a combination of both? Your strategy will influence your holding period for the EWU ETF. Some investors might hold it for income and reinvest the dividends, while others might focus on long-term capital appreciation. Alright everyone, that's all we have for the EWU ETF today on Chat ETF. So, what are your thoughts on the EWU ETF? Let us know in the comments below. Is it a good fit for your portfolio, or are you looking for something more specific? We love hearing from you. Don't forget to like this video if you found it helpful, and we'll see you on the next episode of Chat ETF, where we'll be exploring another exciting corner of the ETF world.